Hi, everyone. Larry Berman here. Again, late Friday afternoon, looking at the markets. A lot of green on the screens today. It's been quite an interesting few weeks here with a real undercut. To be fair, I was really surprised. I was thinking peak inflation was going to be May, and that would be the bottom. I think what this last swoon down did was wipe out a lot of confidence money that we were going to be okay. What's happened in the last few weeks? Well, let's have a look at some of our screens and see if we can figure that out. So here we are, and what we're looking at here is the Eurodollar curve. As you can see, it's a 10-year curve, and the swap market goes out for 10 years. But what I want to focus on here is the three curves. You have the red curve, which is today live. You have the green curve, which was a week ago. And you have the blue curve, which was a month ago. A month ago, expectations was for interest rates to peak in terms of the Eurodollar market, remember, spread over treasuries. So this was going to put the terminal rate from the Fed funds probably around 2.75 to 3%. It's a month ago. CPI data comes out, it's hot, shock comes to the market. As of a week ago, more aggressive, faster Fed, we've seen that narrative. So the green line steepens. We get out to a higher terminal rate where Fed funds would be more in tune with about 3.5 Fed funds rate. So that's in line a little bit more actually than where the dot plots suggested. But now the terminal rate was not June, but March. So we're going to get there faster. So what's happened in the past week? We've now started to move where that terminal rate is now seen on a December contract, where by March and June, they're actually starting to ease. So the narrative of the market is changing. The Fed is catching up with the curve, and we're already starting to see from an economic perspective some of these, what the Fed's doing, already having an impact. This is the economic calendar results from the past week, and what you can see here is that the U.S. from a trade perspective, ugly Q1, more impact in terms of negative GDP. We may already be in a recession. Markets just don't know it yet. As my friend David Rosenberg likes to point out, jobless claims, it's not about the level, it's about the trend. And in the last month, that trend of initial claims is starting to tick up. So we're starting to see more layoffs than not in a big way by any stretch of the imagination. Two numbers that came out yesterday that I think were dramatically changed opinion and why those eases started to pull into the first quarter next year is that both on a manufacturing level and a services level, global PMIs are now quickly trending towards below 50. And we all know that means significant economic slowdown. The official recession target is around 45, 46 for these things. So we got a bit of way to go, but these things are slowing rapidly. This morning, Michigan final sentiment numbers, another notch down. But here's the key thing. Inflation expectations 1 year out, a notch down. Long-term inflation expectations, 2 notches down. We're getting that more of a perfect outcome that the Fed has been talking about. I don't believe it for a minute, but that's what the market is starting to believe. The Fed's getting ahead of the curve. New home sales rocking, okay? We heard from the home builders this week. They all reported good numbers. They are seeing signs of slowing. So we're already getting that negative economic impact. We may already be in a recession, which means the Fed may not be able to raise rates as much as they think. Markets will like that. Inflation starts to cool. So let's look at the S&P 500 and what it's done in the last week. Again, GDP surprise, significant gaps down, wash out, clear out all the stops below the lows. Powell speaks, Fed moves, they're more aggressive, testifies to Congress. Now we're coming back into the range. So first area of resistance, first gap, next gap. We probably at a minimum next week get to the 4,000 level on the S&P. What economic scenario do we need to test the top of the channel? There's not one I can think of anytime soon. So we're still very likely in a pattern of lower lows and lower highs, projecting out the next few months, whether it's the falling 200-day average, the 50-day average, the top of the trend channel. These things are all coming down. And ultimately, I think, limit the upside. When we look at the Fibonacci's, where do we retrace to? If this is a true bear market, we're not getting likely above that 50%, and most certainly not above the 61.8. 420 on the S&P ballpark is good. These highs that we saw pre the CPI report, there's a lot of wood to chop in terms of guys going to want to hedge up and sell into that, and that's the most we can look for. It'll pause along the way, but right now, a lot of that negative sentiment was in the market, has changed. The narrative has turned a little bit. Let's look for a continued bounce. Best way to play it for the speculators out there, here's my biggest position in my equity fund right now, Carnival Cruise Lines. And what are you saying now, Larry? Are you crazy? Look at that. It retested the lows, very close to the COVID lows. They did a big refi. It put pressure on the stock. They raised $1 billion recently. Earnings, obviously through COVID, terrible. They reported this morning. Stock is up more than 10%. I think it's a good bottom. This is worth at least $20. And if you can project out, plug your nose for 3 to 5 years, it's probably a triple from here. So for the bull pick of the week, we've got our Carnival Cruise Lines. And let's go back again to the bear pick of the week. Where do we hedge up again? So we've lifted all our hedges. We're a little bit long, and we're looking for 4,000 and above to start getting more cautious on broad market exposure. Have a great week, everyone.